All right, ADP, man, ADP. All right, we need to start a little early because ADP is at 8:15. So, yeah, let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Let's get a headline news update. Pi Network price forecast. PI recovers as co-founder fan participates in Token 2049 event. Gold hits new record high as U.S. shutdown boosts safe haven demand.
Crypto today. Bitcoin, Ethereum, XRP tilt toward breakout on risk-on sentiment.
Pound sterling refreshes weekly high against U.S. dollar.
Euro, yen, tumbles to near 172.50 as Japanese yen outperforms across the board.
Yeah, the Tankan survey yesterday.
US dollar hesitates with US ADP employment data. Manufacturing PMI in tap. Ukrainian diver wanted over Nord Stream explosions detained in Poland. Yen outperforming on reassertion of haven role amid US shutdown. Scotiabank.
India, N three-money supply, fell from previous 9.5% to 9.2% in September 15th. Czech factory activity remains in contraction.
All right, so we have this idea of a move to safety over the U.S. shutdown. Okay, yeah. But that might be overstating it a little bit. Unless you see massive dollar strength or something today. But what I'm leading to is yesterday when I was trading the Asia session, the Tankan survey came out, and the results were such that the Bank of Japan could continue raising interest rates if it wants to. I think that is the bulk of what we see. But then from the American point of view is, oh my God, the government just shut down. Oh, look at yen. It's super strong. That must be why. Well, it's probably partially true, but not necessarily completely true. Yeah. So I've already spent an hour talking about the government shutdown this morning. So our focus shall be ADP in 51 seconds. Okay, anything around 50 makes sense. Is it going to be a negative number? Is it going to be over 100? I don't know. We'll find out. And then it's PMI season. So PMI. Lots of PMIs in Asia last night as well. Japan was like 48 or something. Not good if you're supposed to be manufacturing. No, well, they're contracting. All right, so here we go. 7, 6, 5, 4, 3, 2, 1. What do you think? Pi Network price forecast. PI recovers as co. That's the every 15 and right. Every 15 and 45 it does that update. Still no answer. I'm getting an hourglass. It's not us. So while we wait for ADP, guess what? There's no weekly claims tomorrow. There's no NFP on Friday. The governments are shut down. There's no one to release the report. So I spent an hour this morning, as I said, discussing what a shutdown is, why why shutdowns occur, the actual mechanics of a shutdown, all that kind of stuff, and maybe even the political strategies around having one, how it could impact interest rates and yields and dollar flows and yen flows and gold flows. Holy smokes. Oh, Fed cut, Fed cut, Fed cut, dollar weakness, dollar weakness, dollar weakness. Oh my God, it's so awesome. All right, so let's take a look at the dollar. Well, let's go over here. Let's look at it from an indice point of view. It's a good way to look at dollar versus everything. My first thought would be dollar weakness. Yeah. Lovely. Yeah. Yeah. Contraction in. Ooh, I just got 2 dividends paid. Nice. Cha-ching. Anyways, yeah, baby, yeah. Dollar weakness, Fed cuts. Fed cuts. Mm-mm. That should be good for exotics, but it probably will also be good for euro. Let's see. Pound loving it. Euro coming down too. Ooh, that's interesting. Bingo. All right. Cool. Let's do some exotics. Who's loving it? Yeah, Euro Rand. I've been in this trade a month. Okay. USD Rand down. USD Peso down. Look at the beautiful roll reversal we just had a few days ago. Just bright as rain. Now, what we've discussed, of course, is just on the basics of the Fed cutting. And we've known that for multiple weeks now because they started and they gave us their dot plot that you would roll money into exotics. I talked at great length about that. And they're all working. Nice. Now, Euro Rand should be mediocre, but let me discuss this. Like USD Rand and USD Mexican Peso, you would think would be down, 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 down for years, possibly. Okay, great. But I've talked about that for hours. So why am I in Euro Rand? Well, if dollar weakens, I would assume on the long run, maybe not day by day or hour by hour, but in the long run, the euro benefits from the weak dollar. Just think of it as euro is stable and priced in dollars. Like if you just fixed Europe, you just fixed it like a euro bar. That's a line you put to lock euro, and dollar fluctuates. Let's just think of it like gold, right? So dollar fluctuates, but an ounce of gold is always an ounce of gold. How much is the ounce of gold worth? Well, that fluctuates. So imagine you fixed euro and dollar weakens. Well, then you need more dollars to buy a euro, and that pushes euro dollar up. Okay. So then why am I in this one? And a couple of things. Dollar is still expensive. So it's not the greatest carry in the world because there's high borrowing costs. Even though they're getting cheaper, it's still high, eating into your swap. The second thing is you're going to make 10 times more money on the pips than you are on the carry for USD Rand and USD Mexican peso. So is it really a carry? It's kind of a carry, but you're really just crushing it on the pips. It's still a good trade, but is it truly a carry? See, a carry trade, a good carry trade, you don't care about the direction per se because you're kind of breaking. U.S. private sector payrolls declined 32,000 in September versus Wayne. plus 50,000. Okay. Um, let's say a perfect, beautiful carry trade basket would be such that you would always make money no matter what happens. So you build a basket and some of the trades go up, but other things go down in that circumstance. And then when the circumstances change, something else benefits, but something else loses. And let's say you designed a basket of currencies, like this is financial engineering now, they always offset each other. And generally speaking, the value of the basket of currencies or assets never really changes. And if it changes maybe ever so slightly in your favor, but that's not the point. You don't want to build a basket that's going to not be in your favor. But the point is you want to collect the carry. And so now you have to look at the cost of carrying because some of those trades that you're in might actually have negative swap. But at the end of the day, if you were just guaranteed 1% a month profit no matter what happened, you're going to do great. And this type of engineering is what I use in our Council of Investment Advising. I don't want the stock market to fall, but it doesn't bother me that much because the way it's designed is the stock market could go up, down, or sideways. On the short run, I don't give a damn. I'm still going to make 12% a year in cash flow. I don't care about the value of the apartment building. It goes up, it goes down, whatever. But every month I collect rent. Right? And that's how you want to do a carry. So let's get back to the point here. If the dollar continues to weaken, I think euro will likely appreciate in terms of dollars. And that's such a big trade that in general, euro would appreciate, lowering their inflation and all that kind of stuff and increasing their purchasing power. Okay, so up for euro on the long run, not necessarily today, but let's say over the next year, if the fundamentals continue, right? But then you're like, but what about Rand? Yeah, but the dollar would be weakening. That's why euro's going up, which means USD Rand is falling, which means the Rand also appreciates. So what happens then? They are designed to offset each other. So you can see my entries way up at the top here. And now we've made a new lower low, lower high, which is great. So I'm going to look at it this way for sure. So this is how I'm doing it technically. But then the engineering of it is it may not make a lot of pips on the long run. It might just go down and then back up and then kind of down and then back up and then down with the ebb and flow of the US dollar, which isn't even in this. But in a weird way, I'm long euro dollar, short dollar rand synthetically. And what's the outcome of this? An internal rate of return of 50% a month, not including any pips. An 50% monthly IRR. What? So what does that mean? All right, look, it's one mini lot. Huh? Billions of dollars on the line. Well, let's think of it mathematically. Like whatever your lot size is, it doesn't matter mathematically. It's relative to your account size. This is only 30, but I started this year at 36, at 30, and I think now it's 36, 37, something like that. But my point is, whatever, a trade is a trade. You're still going to get the same, internal rate of return, right? Okay. So this cost me a little over $100 to enter this trade. We call that margin. Look it up. Oh, look at that. I have 38,000. Cool. Anyways, what are the numbers here? I sold about a month ago. Okay, great. And it cost me $114. Now, if you only look at the carry, otherwise known as swap, $54 a month. Breaking U.S. private sector payrolls declined 32,000 in September versus plus 50,000 forecast. So right? So, what's the actual? So my internal rate of return in the first month, okay, is 46. Or have I been in it 2 months? Wait, August. Wait, maybe I've been in 2 months. That would cut that in half. 2 months. So that's traded it. We'll call it August 1st. Oh, I've been in it for 2 months. Oh, okay. Well, that changes it dramatically. Okay. So per month, 23.4% internal rate of return. Okay. That's still pretty good. 25% a month. And so you'll see dollar for dollar, you don't want to get to a point where you're making so many dollars on the pips that you bail on something that's paying you so wonderfully. So if you could neutralize and move sideways on this forever, then you just maintain your 25% a month forever. Cool. And now the cool thing too, as you know, one thing that's unique about being a foreign exchange trader is that money is already in my account. You don't have to exit the position to get paid. I get paid every day, 7 days a week. And so anyways, so that's what we're talking. And it incorporates the perceived future value of US dollars based on the analytics of the dot plot, which is essentially the probability of interest rates in the United States in the near future. All programmed into that trade, but USD Rand and USD Mexican Peso should be doing well, and Euro Rand hopefully is just sort of neutral to down. And so I've been in it for 2 months. How about 3 months more? How about forever? And then, of course, every drop and lower high, you could add another and add another and add another and add another. And let's say over time, instead of one mini lot, you could have one standard lot. Each one entered one mini lot at a time. Each time you're able to move your stop loss to break even. And over time, okay, you're still making the roughly 25% internal rate of return dollar for dollar on each trade. But instead of being up $25 a month, you're up $250. And you have the same amount of risk because your stop is at break even. And so your real risk is opportunity cost, where your break even, you're making money, comes back, knocks you out at break even. You didn't actually lose money. You collected every day swap, but now you don't collect swap on that position because you got knocked out at break even. So you had it, now you don't have it. But you're like, wait, $25 a month, then $250 a month. You're like, that's pretty good. Yeah. A bigger account. Okay. 10 trades with standard lots each taken one at a time. Each one moved to break even before you entered the second one. So weeks or months go by until you build that position. But now instead of 10 mini lots, you have 10 standard lots. Now, relative to your account size, it should still be tiny. But my point is, now it's $2,500 a month in swap only. No matter if the market goes up, down, or sideways, you're like, I'm going to get paid. And not at the end of the month, every day, right? Every weekday, essentially, you're getting your proportion of 1/30th of 250. Sorry, 2,005. Huh? So what is that? $100 a day forever? Okay. U.S. private sector employment unexpectedly decreases in September.
Greece manufacturing growth eases in September.
So imagine now you're running $1 billion fund, okay, and you're able to generate something like $100,000 a day forever, and you've hedged out all the risk. All your stops are at break even, and no matter what happens, you collect $100,000 a day, or whatever it is, $1 million a day. And you're like, yeah, pretty soon that's good money, but you're not making any pips, you see? So, Prince, I addressed that earlier. Let me say it again. Um, it would be a risk-off alternative to U.S. dollar, especially now that you would expect dollar to be weak. But the second point, Prince, is yesterday in the Asian session, the Tankan survey came out, and the results were such that the Bank of Japan would be able to raise interest rates in the near future, which we've already plotted out, but the market doesn't fully appreciate any of it. Like they still don't know. The market's still struggling to figure it out. The Bank of Japan have already told us they're going to raise interest rates, but now the market that doesn't pay attention is just figuring it out. And so the Tankan survey, plus Asia, I think is in Golden Week, isn't it? Isn't it Golden Week? Anybody? Um, but so anyways, it seems that people have just woken up to the fact that Japan's going to raise interest rates again. Yeah. And we already know that. Yeah. But whatever. All this is going to be replaced when 2.0 is launched. I am super excited and I can't wait to introduce you to a completely rebuilt economic engine that moved away from 90% being algorithms and 10% of it being AI to a new Tradars where all its economics and analytic tools have similar, let's say, algorithms that need to pull from databases. Like we still gather from all the different databases. So, like I spent yesterday, I don't know, 8 hours yesterday inside of Stats Canada and the Bank of Canada. Not inside the building, inside the data. And today, probably the ONS for the UK, going through millions of tables of data and manipulating it and all that kind of stuff. But that's still algorithms. But now those algos are built on a large language model that I've designed as an economist and as a trader. So I've taught AI how to trade like Wayne, how to think like Wayne. And the cool thing is, not only can we display the data in the way that we do very well now, I can do significantly more complicated and sensitive calculations far beyond what we're doing now. And then you're like, well, Wayne, I barely understand it now. I don't have an economics degree. Oh, but I've taught the AI as if it as if it does have an economics degree, or that it's been trading technical analysis with using moving averages and pivot points. So my point is we can do vastly better and more sophisticated calculations, but it meaning Tradars, can also do the analysis for you and just plain language tell you it makes this bullish, it makes this very bullish, this one would be neutral, this one might be bearish, and here's why. And we looked at this, we looked at this, and 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 we looked at this. In fact, we looked at 21 different variables and did contrast and comparison, and then did it over multiple currency pairs with different weighting with the anticipation of its impact on potential monetary policy in the near future, and correlated that. And, dude, and calculated the average over quarters and over weeks and standard deviations and with linear projections. And dude, like insane. Tradars 2.0 is amazing. And we're already under our first test because we just found out the government is shut down. So we had ADP today, which is a private company, not a public company. Wait, not a government agency. I want to make sure I'm using the right terms here. But BLS is shut down. So no non-farm payrolls. And what about weekly claims? And what about this? And what about that? Well, now I get to compare and contrast through the rest of this week what Tradars 1.0 thinks and what Tradars 2.0 thinks, and be able to compare and contrast based on the gaps now in the data. And I can't talk to Tradars 1.0 and say, hey, this is what's happening here, and this is why there's gaps in the data. How do you think this would impact global money flow? How do you think this would impact yields? How do you think this would impact the stock market? Are we going to have an increase in volatility, or is it, and with Traders 2.0 being 90% AI, yeah, I can have a straight up conversation with it and teach it. And so when you log in and you look at all the data and you're like, man, this is awesome, but it's confusing. What does it mean? It'll tell you. And it'll do like dozens of calculations and then think about the totality of the combination of all these things based on quantitative analysis of 20 years of history, how it may or may not impact our real world today, so that you have a way to understand the opportunities and threats in front of you right now. Oh my god. Huh? No, Mahai, I just saw what you said up there. You remember me saying that Christmas rally starts? No, no, but yeah, between Halloween and Thanksgiving. No, no, that wasn't me. That's not what the Santa Claus rally is. The Santa Claus rally is in the last 2 weeks of December. What I'm talking about is seasonal flows, which is not a Santa Claus, but it is seasonal. Richard is asking about communicating with central banks. Cost isn't the issue directly. It's that they all use different technologies. They format differently, and also they have millions, if not, well, they have thousands of data series, and inside millions and billions of data points. And some are expired, some are not, some are calculated right, some are calculated wrong. So that's not the issue. So, like with I think it's the Bank of Canada that doesn't, okay, it offers trade balance, let's say. So the Canadian trade balance right now is negative 4.4 billion. And you can go to either Stats Canada or the Bank of Canada. So right. So there's two sources there. And I think if you did some searching, you could probably get that number because they're displaying somewhere. Yeah, but I'm not scraping the website. I'm in the same data that they have, and I'm manipulating it the way that they have. Now, so you could just say, well, hey, Stats Canada, just give me the trade balance. Guess what? It's not that easy. In fact, there's a lot of data related to that, old data, new data, current data, and stale data. But then you want goods and services, but you don't want like some other like financial flows and all that kind of stuff and foreign direct investment. So you got to take all that out. And you would think you would just get a simple number, right, Richard, of like, hey, what is the trade balance in Canada? Well, the current trade balance is negative 4.4 billion. No, 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 no. So it turns out with Bank of Canada, but not the other central banks, the best, most reliable way to do it is to find the data series and the data points that give you the trade balance of goods in Canadian dollars, the trade balance of services in Canadian dollars, strip out all the other extraneous data that is also thrown into the database, and then do the calculations. In this case, it's an easy calculation, but sometimes it's complex. And you then have to derive that, right? that there's a trade deficit in Canada of negative 4.4 billion. You can't just say, give it to me. So you might spend a lot of development work to do all of that just to get something as simple as what is the Canadian trade balance? Yeah. So that, so the API access isn't where you spend your money. Yeah. But it's supremely fascinating. And so now imagine every economic data point you care about, you have to sort through the haystack to find the needle. And to get that, you might have to do the math. And then program everything in the language to be able to fetch this data, and program it to pull it and put it into your database and structure everything correctly inside your database. And then you got to take your database and do a front end on it to display it. But how do you want to display it, and what format and what technology? And all of a sudden you're like, dude, okay, all right, the API isn't the issue, but it is the issue. It's just the first step. And none of the central banks are the same. Doesn't it sound like fun, everybody? Okay, and we haven't even talked about the AI, right, Richard? So once you have all that, teach it, what does it mean? Yeah. How do you make a decision with all this data? Well, that's where, you know, I'm also adding value. Not just fundamentally, which is probably pretty straightforward, but it's also technical. Well, first of all, I do, but the Fred is good for many things. So, like for the United States, the Fred is great. But just try this, though, Richard. Tell me the quarterly change in GDP stated year over year as a percentage change. What I'm trying to say is, what's GDP in the United States? Oh, 3.8%. Good. Okay. Go to the Fred and find that. So if you don't know what the Fred is, everybody, it's the Federal Reserve Economic Database run by the St. Louis Fed. That's why I've been there a couple of times last year. Okay. Seems easy enough, right? Oh, Wayne, well, you go to the Fred and you click on GDP. So remember, we're looking for 3.8. Okay. Is that okay? GDP nominal, or is that GDP real? Is it per capita? Is it a percentage? Is it real? And then all of a sudden you're like, wait. What is this? And then what? What? And all of a sudden look at all the GDPs. Well, which one are you going to use? Okay. So let's just say the first one, because real, you have to account for inflation. Maybe you want that. Both of these were updated 6 days ago. Some of these haven't been updated for years. So it seems like this seems pretty easy. So it's this one, right? Does that say 3.8% GDP? No. Okay. Well, maybe it's this real one, the one we didn't do. Oh, well, it's a different number, so it's accounted for inflation. But wait, it's okay. So now what? Is there a percentage change down here? No. Is there a percentage change here? No. What if you do see more? No. Okay, so now we go back to this one. So maybe now you edit this graph. Okay, units, billions of chain, 217 or 2017. So that's the real. So let's not do real. Let's go back and do nominal, just for fun. Okay, I guess it's this one, right? Nominal. Okay, and let's change what we're doing. We don't want billions of dollars. Is it change from a year ago in dollars? No, percentage change. That looks good. But do we want month over month or year over year? I guess we want year over year, right? 3.8. So this should give us the number, right? And the number is 4.6 right here. Is that the right answer? Is that GDP in the United States, everybody? We're expecting 3.8. What is this? Well, that accounts for inflation. Okay, well, let's do it again. This time we'll do real. That should lower it. So now we go here, manipulate the data. We'll do percentage change from a year ago. Okay, 1 year ago measured quarterly. Quarterly percentage change. Quarter over quarter, year over year. Oh, 2.1. Well, no, it's supposed to be 3. Okay, annual 2.8. Wait, but it's 2024. Oh, yeah, because it's annual. Semi-annual 2.1. Wait, quarterly? That's not right. Percentage change total 0.9. Quarterly? Annual? And all of a sudden, dude, Richard, why can't you just go into the Fred and show me that GDP is 3.8? I put federal. I want to go to the Board of Governors. Apparently I have to spell it. Okay, look, GDP 3.8. See, I know my stuff. Okay. So now you're like, okay, I can't get it from the Fred. You see, Richard? Okay, let's get it from the Bureau of Economic Analysis, BEA. So now let's drop the Fred because you thought it was easy and now it's not. So now tie into the BEA database through their API if it's available. It's going to be formatted differently. Then you got to find the data and view it and see if you get this 3.8. But now imagine you run into these problems like we're dealing with the United States. But now you have to do it for every country in the world. And where you're like, well, what if New Zealand and Australia don't tell you what the yield on the 10-year treasury or 1-year treasury or 3-month treasury, because you'd like to calculate the yield curve analysis. And you're like, well, you get that from New Zealand or the Australian, statistical agency. And all of a sudden you're piecemealing everything. So when calculating the data for the United States, and you're trying to do something as simple as get the data to show a 3.8 GDP second quarter year over year analysis just for that one piece of your puzzle, go to the BEA, go to that data set through their API, and then pull it and verify it and then place it into your database and then do whatever calculations once you have it. But then you're like, well, for trade balance, do something else. For inflation, do something else. And all of a sudden, every cell in your database has a different process and procedure, and you're documenting all of this and automating all of this. Like, do you understand the insanity? This has all been solved. I've already done all of this. Okay. So 78.3 billion, I have proved this number about 5 times, 5 different ways, using 5 different databases through different agencies. And I know that to be true. I also know 3.8. I know 4.3, 4.3. All these things but to prove it has been a very significant challenge. And but it's great. And now this is the easiest part, Richard. Okay. So imagine you have hundreds of data points and each one has to be done uniquely. Then you have the data. And now you only have the foundation poured. You don't have beautiful architecture. So what I'm building for you, there's 2 things. It's got to be visually easy to understand. And it must also do calculations and analysis and generate easy to understand output based on, let's say, master's level understanding of global macroeconomics, and then do a comparative analysis of what is actually happening in the market. So now you need price data, not just economic data. And then say, well, based on our scoring, which now means a different math, so calculations and then weights to variables, how will this make me money today? So, like, what we're talking about, obviously, is not as easy as you'd think, right, Richard? But it's by far the easiest part of the project. Yeah. Oh my God, you guys are gonna love it. Uh so will this be, you're talking about where did Tradars go? Okay. All right. So you're saying under the fundamental section, will we upgrade um this tab, right? Okay. None of this will exist anymore. Nothing. I've I have built, well, how do I say it differently? The code that you're looking at here, 100% of it will be gone next week. Not one piece of code. Yeah. And so many of you know that this is built on Data Studio. there's no data studio. I'm not even using data studio. I'm not using the data set. I'm not using the code. I'm not using like this gauge is just something that's built into Data Studio, now called Looker Studio, which is a data visualization tool that's provided by Google. It's not even the same platform. It's not the same code. It's not the same data source. It's not the same math. None of this will exist. It's all been rebuilt from scratch using the latest and greatest and most advanced technology on earth. You're welcome. So, to answer your question, this won't exist. Have I? Yeah. Did I upgrade it? It's it's gone. This is the. You'll only see it a few more days, and my like risk analysis is so complex. It's got like 4 levels of how do you say? It's not calculations. It's 4 levels of different types of calculations based on not 8 constituencies on 3 time frames, but dozens and dozens and dozens on 3 time with dynamic weighting and comparative analysis and adjustments for short, medium, and long-term data. And then translating all of that, not through algorithm, but through artificial intelligence, into a multifaceted scoring system. And then it will explain it to you and how it got to its conclusion, and then provide quantitative analysis of its confidence level. And then provide means and standard deviations and linear projections of its calculations of these hundreds of variables and dynamic weightings into, yeah, markets look moderately bullish today, Richard. You understand, like, this is magnitudes better in quantitative analysis that was impossible 6 months ago. But since I've been on AI now for about 4.5 years, I'm on top of the new capabilities instantly. So, anyways, dude, can you tell I'm a little bit excited? You're going to have a super brain to work with every day, and me. And together, the machine itself will communicate with you. And then I can also communicate. I'm just not a machine. But you'll have the data and you'll have the knowledge, because Tradars will explain how and why it gets to its conclusions. It's not just the data now, it's the conclusions. So if you said, well, Wayne, why are you very bullish on pound Kiwi? Oh, well, you'd have to go to the scorecard, go to the scorecard summary. And you're like, okay, pound Kiwi. Well, we give it a 10, COT is a 0, sentiment is this, seasonality is that. And so it's displaying the data. And then you can say, okay, well, let's get a little deeper. Let's now go to pound Kiwi. See what I'm doing? And then you say, oh, the currency pair has a score of 10. And the score changed by nothing. So it's a 10. Okay, how does it get to a 10? Okay, look at some seasonality. Okay, great. But you had to do all of that, and you still may not understand. So you're just like, okay, it's very bullish, but I think maybe it has to do with GDP, or maybe it has to do with jobs, or interest rates, or maybe it had to do with COT. But you know what it's not doing? Okay. Let's take one very basic thing. Seasonality. A 1. Okay. Let's do the seasonality. So now you got to find it. You have to know that this is what we're doing to have our discussion. You need to know to be able to do it. And you see, okay, from the low in September to October, it goes from a low to a high, which would be a 1. But you know what it's not doing? It's not thinking about, well, the transition from September to October to November to December. It's binary. It's just an algorithm. If the difference between the September, which is on a 5-year bearish, to October either less bearish or bullish, then report a 1. Is that thinking? That's not thinking at all. That's an algorithm. It's a mathematical construct. If the difference from here to here is a positive integer, place it in all the different parts of the website as a 1. But what if you're on the last day of October? Should you know that the next 8 weeks is down? And we don't know when in October. Is it the middle of October? When does it turn? It doesn't know that. It's not thinking. Tradars thinks. It knows. And it'll tell you the likely patterns inside of October, when they occur, and then how that should lead into November. It communicates to that level. Okay? It actually thinks. And this version of Tradars 1.0, says, okay, we have a database, and I create a 5-year average, create a 20-year average, and every time there's a new month of data, add it to the seasonality and drop the old data so that we constantly have a 5 and a 20-year. And then display it. Okay? Tradars 2.0 doesn't do that. We have all the data, and I've taught it how to think and analyze the way I do, technically and fundamentally. And the content is generated dynamically on need. So this is just a spreadsheet. And Tradars 2.0 is more like a neural network. So it will say, oh, well, why do I think this about pound kiwi? Well, let me tell you what my thought process. First of all, if you look at, and then all of a sudden it's just creating all this. If you look at this and you look at like the second and third week is a transitionary week in October, and it's going to roll over, and November has on average over 20 and 5 years to be down periods. I can prove it, this way, that way. And if you think about the divergence in monetary policy at the Bank of England versus the Reserve Bank of New Zealand, and you do this and you do that and you do that. I think somewhere in the second and third week, you should be prepared for a transition of this was bullish to significantly less bullish, in fact, turning into bearishness. And I have an 80% confidence level on this because of this, where Tradars 1.0 simply says we keep an Excel spreadsheet that calculates this. And right now, it's negative 0.79. And then when we do the calculations for the next month, it's positive 0.47. It doesn't have a brain at all. So it's not looking at this and analyzing. That would be very basic, wouldn't it? To say, hey, artificial intelligence, why don't you look at this monthly data and the weekly data and help me put in a transition plan from bearish to bullish and then bullish back to bearish. Oh, well, we tend to peak around week 41, which is not far from now. Okay, but it can't do that. It doesn't have a brain. Tradars 2.0 can. It looks at this and dozens, if not hundreds of other variables and thinks about it and then comes up with conclusions and then can explain it to you intelligently using both fundamental quantitative analysis, but also things like technical in its conclusion, and then explain it to you in a logical, intelligent, easy to understand process based on levels of complexity that we can barely comprehend. Yeah, I know, right? So anyways, I hope I don't oversell it. It's complex, and I'm sure it's going to be challenging in our first few weeks of launch because of that level of complexity. And, there's going to be a data fetch that fails. There's going to be a central bank that suddenly just changes its format or its APIs. Or it's going to be a bitch in the beginning. And I really, really thank you for the patience that you are showing me, but also the patience you're going to be required to show me. But I'm telling you, we're magnitudes into the future, and Bloomberg can't do this for $2,200 a month. Bloomberg. So I used to say, I want Tradars to be the Bloomberg terminal for retail traders and investors. Now, I think Bloomberg terminal for $2,200 a month is stupid. And we're smart. That's a big difference to go from stupid algorithms just gathering the numbers and displaying it on a terminal to now an analyst communicating. Seriously. Yeah. So anyways. So I'm trying to help you build a sustainable trading and investing business. Cool. Yeah, it's neat stuff, I'm telling you. So that's what I'm going to go work on right now. Right? The dollar is weak. That's great. I'm already a seller of dollar. I don't know about the stock market. It's not even open yet. The government shutdown is not good for the stock market, but the bad ADP is good for the stock market because the bad news forces the Fed to cut, and then the cut is good, and the dollar weakens. And, well, we have levels of complexity, but even with 1.0, at least I can say, well, the dollar hasn't strengthened or weakened at all over even 30 days. The dollar hasn't done jack. So what if today the dollar spikes 1%, even though it hasn't even moved barely a tenth of a percent over 30 days? So what if there's a giant spike on dollar index today? Would it matter? Is any of that flowing to dollar? Is any of that, to gold? Is any of that flowing to the 2-year or the 10? Which one? Short end, long end? Okay. And so we can actually, as volatility is spiking, are investors in the options market hedging through puts and calls? Well, we can analyze all of that. Yeah. But it doesn't tell you what to do next because it can't think. And so just like under the new version of this, which is 10 million times more complicated than this, but it'll look at the 2, the 10, analyze the yields, understanding where the money flow is, calculating the spread, is the spread between the two widening or narrowing, and calculating the steepness of the slope of the yield curve, of whether is it steepening, is it flattening, is it flat, or is it inverted? And then translate that into knowledge of not only is it fundamentally happening, but what does it mean and where is the trade? I dropped my mic.